No losses will be borne by the taxpayers.
People of America need to know what happened at these banks.
Back in March, when a fresh banking crisis reared its head, it wasn't a huge surprise when one man emerged as the financial sector's white knight.
Turning now to our top story. First Republic Bank sold to JPMorgan Chase this morning in a government-led deal.
Jamie Dimon, the 67-year-old CEO of JPMorgan Chase, is no stranger to stepping in during times of turmoil. In 2008, he rescued Bear Stearns, now a relic of the financial crisis, but once a giant of the investment banking landscape. We did it because we were asked to, he'd say years later. 15 years on, it was Treasury Secretary Janet Yellen who pushed him to reprise that role by contributing billions alongside other big banks in an emergency infusion to First Republic. JPMorgan bought First Republic less than 2 months later from the FDIC. Wall Street's apparent savior was perhaps not the title Dimon was looking for, even if he was destined for it. Dimon's first job was at American Express as an assistant to his father's boss and family friend, Sandy Weill. Weill would become the seminal figure in Dimon's professional life for the better part of 2 decades. When he left Amex, Dimon followed him. By the age of 35, Weill promoted him to president of Primerica, making him one of the youngest leaders on Wall Street. The quick-thinking number cruncher had truly arrived, but his tenure at the newly created megabank Citigroup would be short-lived. Dimon was cut loose by his mentor, only to bounce back as CEO of Bank One and with a point to prove. He immediately bought 2 million shares of the company's stock, burnishing a reputation for putting his money where his mouth is. In 2004, JPMorgan Chase swooped up Bank One for $58 billion. The joke on the street was that they'd paid $58 billion for Jamie. Now, he's one of the longest-running leaders on the street, and running a bank whose assets dwarf its rivals, it still regularly racks up record earnings. To some people, JPMorgan is its own economy. The man behind the fortress balance sheet says he is still going strong, and at what he calls the most dangerous time he's seen in decades.
We're a few hours removed from Fed decision day. Your assessment of what we heard from the Fed?
Well, my real assessment doesn't matter that much because we don't know the future state of the economy, which they've basically been telling you now for months. And I think they did the right thing to raise rates rapidly. And I think they're kind of right to pause here a little bit and see what happens. But I suspect that they may not be done. I think there's a chance that inflation is just a little stickier than people think. And the fiscal and monetary stimulus of the last several years is more than people think. Unemployment's very low. We'll see.
They have a long way to go on inflation. I think Chairman Powell, Jerome Powell, made that very clear. How much higher do you think they have to go on rates?
So you have to separate rates into the short end, and it's called the 10-year. And on the short end, they are 5 3/8, whatever, maybe 25, 50, 75 more. And I'm not predicting that. I just think there's a higher chance than probably other people think. The 10-year is not set by them. So that went up, they influence it with words and stuff like that, but that's supply and demand of buyers of bonds from around the world. The supply is up dramatically, much more than people would have expected even a year ago. And QT is also increasing the supply of bonds out there. So is Japan, China, and some other, prior buyers. So that I think there may be pressure in that 10-year rate to go up. Inflation stickier. It's not abnormal to have a 5.5% or 6% or even 7% 10-year rate. And I don't look at that as a prediction. I look at that as more like risk management. Don't rule it out when you look at how you manage your company, that rates can go a little bit higher. I should also point out the spreads are still very low. So credit spreads themselves can go up. So there could be a little bit of a double whammy for borrowers.
Has the economy felt the impact of the Fed's rate hikes? And then I know you've talked a lot about quantitative tightening. Has markets and the economy felt these things yet?
Yeah. So the Fed, you see it, like remember mortgages are a lot of fixed rates, but it's clearly affecting house sales, home sales and stuff like that. Not home prices yet. There's still a lot of money out there, and but it's affecting auto sales and credit card, and over time it'll affect businesses that have to refinance any floating rate bars. So yeah, of course it's depressing certain economic activity. It's hard to figure exactly how much. Quantitative tightening is almost more of a technical thing, like what's enough, when's enough. I personally believe that at one point it will rattle the markets. It kind of did in March 2020. It did if you go back to 19. Market makers are more they can't do as much as they used to do for a whole bunch of different regulatory reasons. And so I think at one point, yeah, you're going to see markets get a little rattled.
And where does that rattling show up first, you think?
Treasuries.
Treasuries.
Yeah.
And that has the Treasury market been rattled already, just given the ascent we've seen in the 10-year?
Not, well, if you look at, not really, but liquidity has come in. And you should try to keep an eye on that. And like I said, there's more issuance. And the issuance has to be bought. And it may, that may push the price higher. So we haven't seen real, pressure in the repo markets, the overnight markets.
Chair Powell mentioned the 8% mortgage, and he sounded somewhat uncertain what that may or may not mean to the housing market next year. What are you seeing in housing in this country, given where rates are? Yeah,
well, first of all, the big thing, keep in mind also, very different than prior times. We have still a lot of fiscal stimulus with very low unemployment. And consumers actually in rather good shape. They have low unemployment. Home prices and asset prices have gone up for the better part of 15 years. They maybe now, but the equity in their home is at all-time records. They locked in a lot of fixed-rate financing, particularly mortgages, which is like 70% of consumer borrowing. So they're actually in pretty good shape. But it's definitely dampening new home buyers, slowing down people's ability to move. People today are doing adjustable rate mortgages, but the cost of carrying a mortgage is higher. So, buyers either are going to buy a smaller house, which is a choice, or they're going to wait or not buy at all.
For more on Dimon's takeaways on the Fed and the economy, let's bring in our panel. We are joined now by Nick Timiraos, who is the Wall Street Journal chief economics correspondent, and we've got Claudia Sahm, Sahm Consulting founder and former Federal Reserve Board economist. Great to have you both here with us. As we're kind of continuing to let some of those thoughts ring through our minds of what Jamie Dimon had to say there. Nick, I want to go to you first just on what this sets up for a Fed that we just heard of and ultimately how the banks are thinking about the Fed's positioning and the way forward from here.
Well, I think what we heard yesterday is that the Fed is still in inflation fighting mode, but Powell seems more confident that they can fight inflation without having to raise interest rates further, and instead just by holding rates steady. And so that's a change from maybe a few months ago. I think he knows how to signal a plan to hike again, and he declined several opportunities to do that on Wednesday, including at times I thought he was distancing himself from the dot plot, the summary of economic projections in September, where a majority of officials had projected one more rate increase this year. Of course, because of the calendar, we know that would have to be in December. And he didn't really, point back to it. So one interpretation, you could say he was keeping his options on the table, wasn't ruling anything out. That's certainly true. But some of the body language, his read on the economy suggested he doesn't want to hike again if he can, if the data can support that.
Claudia, I want to bring you in here and ask this question to you. What's your take on Dimon's interpretation of the impact of where the Fed is in its rate hiking cycle? What's your assessment?
So I absolutely agree with Dimon that everything's on the table. Anything could happen. The Fed has said numerous times that they're in a risk management mode and also pointed to geopolitical risks, new risks that could show up along the horizon. I do think that they're having a real impact even out at the long end, the 10-year treasuries. The Fed really is looked to as the oracle. Like, let's interpret the data. And I agree with Nick that they have taken a much more sanguine approach that they didn't have to. Inflation had kind of stuck around and wages didn't move down as much as had been expected. And yet GDP has been really strong. And he said, that's okay. We're gonna make progress. And so I think Jay Powell's message was more optimistic than Dimon's. And I think given what we know right now, that's appropriate. And yet, yes, we should prepare for the risks.
Claudia, what do you make of the assessments just about recession at this point in time, and for Jamie Dimon and what they're seeing, not just in how the Fed is conducting its own policy, but also in the customers that they service, and really pointing back to the resiliency of the consumer right now?
I think we need to recognize the fact that we are leaving 2023 in a much better place than most commentators and probably even the Fed thought we would. Consumer spending has held up. Yes, their wealth has increased. We've had people have built a buffer. It's not just the fiscal stimulus at this point. Like, they have set some money aside, and that's really important. And most of all, the labor market has continued to be very strong, even as it's moderated some. And that is absolutely crucial to spending and growth going forward. And so far, it's been a rebalancing that has been gradual, slow and steady. And that is the exact opposite of a recession. You could still have one. There are a lot of bad things that could happen, but so far we are moving in the right direction. I know Nick yesterday really pushed Powell on the recession. Is it in your forecast? And, he said, no, not in the staff forecast.
Oh, Nick, I want to ask you then, what's your assessment of when you think about how Dimon came across as more, I wouldn't call him like, he used the term of like they stress test, basically. They test for these scenarios of higher rates, right? And we're not at 1982 levels, right? Is Dimon too worried or is Powell too optimistic? What's your take?
Well, they have different jobs, right? And Dimon's job is to make sure the bank is positioned for any environment. And I think it's reasonable to highlight the tail risk that, if you pause here and you pause again in December, of course, there is a risk that if the economy is stronger, and it has been stronger than people have expected for 18 months now, and if that continues, I think the risk here is, yes, you aren't talking about doing one more rate increase in the first half of 2024. You're talking about doing, maybe more than one. And so that's the risk. At the same time, Dimon said, in that interview, he would be pausing here. I would go back to something Claudia said. I think the tell yesterday was in how Powell characterized the data. He had opportunities to point to, the University of Michigan inflation expectations number, which was high last month. He dismissed it, not a big deal. He said inflation expectations are moving in the right direction. Stronger consumer spending and hiring, not a problem because we're getting a supply side lift. And so, I thought it was interesting that he just placed more emphasis on the glass half full interpretation of the recent data rather than the glass half empty.
Oh, great characterization there. We'll have to bookmark our conversation, but I want to send our thanks to Nick Timiraos, Wall Street Journal chief economics correspondent, and Claudia Sahm, Sahm Consulting founder, former Federal Reserve Board economist. Thanks to both of you.
I'm of the view that you take what you say very carefully and you put a lot of thought into it. So it really took me, I guess, by surprise on last earnings release when you said this is the most dangerous time in the world that you have seen. Can you just expand upon that? What are you most concerned about?
Yeah, well, it started before the terrorism in Israel with the Ukraine war. I knew it the day afterwards. A free, democratic European nation was invaded by hundreds of thousands of well-armed troops of Russia, protected by nuclear blackmail. And that nuclear blackmail part, just put in the back of your mind, you want to scare people? If you have nuclear proliferation, that's the worst thing. At the time, we said we don't know how it's going to end and when it's going to end. Now it's, not quite 2 years, but it'll be 2 years in February. You have 600,000 casualties along a 600-mile front with no real end in sight. And it's affecting, obviously humanitarian crisis, but oil and food security is paramount, and it's shown the world we don't really have that. It's stretching all alliances. People trying to figure out who's on what side here. And obviously the most important is it's hurting and damaging the ability of China and America to, strike a better relationship. And so I think, and then you have the Israeli terrorist act, and those things are bad. I look at like the Berlin Wall, that went up and came down, not a bullet was fired. You have 600,000 casualties here. And so I look at it, this is maybe a little bit more like pre-World War II. Like, we got to get this right. And I think I like the fact that the Biden administration and others now, Mitch McConnell and leaders are saying, we need to take care of this. It is for America. Because if we don't fix this, the world may not be completely safe for freedom and democracy as we know it for the next 100 years. And to do it, by the way, we need obviously the military stuff is important. We also need diplomacy, development finance. We have to work with our allies. So one of the problems of the IRA Act was it irritated all our allies. We don't want to tear asunder the economic alliances because all these other people are going to cherry pick. And so we have to be very careful how this gets navigated, over the next 5 or 10 years.
In light of these challenging geopolitical situations, the dysfunction we're seeing in government, is that hurting our standing in the world at such a critical time?
America, I think the way you should look at it in the world is, if we reach out our hands to people, people are going to take it. They may get mad at us sometimes for being a little arrogant and a little bit thoughtless, but we are trusted, and we're the only ones, and I'm not saying this is an arrogant American, we're the only ones who can provide the leadership because we have the military, the muscle, the might, the money, the capability. We've got to do it in conjunction with allies. It can't be the ugly American. We're not going to get our own way every time. And I think they understand that. They are rattled by, when they see something, if you look at American policy, it's been less consistent. So they do say, can we trust you? Will you be there? Will the treaty stand? And those are legitimate concerns. It's not over, but we've created a certain amount of uncertainty that I wish we hadn't.
For more analysis on these latest comments from JPMorgan Chase Chairman and CEO Jamie Dimon, we're joined by Ian Bremmer, Eurasia Group founder and president. Ian, thanks so much for joining us again. Now, you heard that interview and you heard comments that Dimon recently saying this, quote, may be the most dangerous time the world has seen in decades. I imagine you agree with that assessment. What are we not paying enough attention to when it comes to geopolitical risk?
Well, I think we are now paying attention. And of course, when you do that, sometimes people get shell-shocked by the headlines, as opposed to remembering which of these things are going to be market moving and which of these aren't. And Jamie knows better than most that the role of the dollar in the global economy is the same as it was 25 years ago. And the role of the U.S. GDP in the global economy is about a quarter, just like it was when the Soviet Union collapsed. But it is precisely that strength and resilience of the U.S. that makes it easy for the United States to make really bad decisions and really inconsistent decisions and not show global leadership in ways that will hurt the world and in ways that will make other countries much less attractive for investment, ways that are hurting the Europeans, ways that are making life more uncertain in Asia, and certainly ways that are making the Middle East fall apart right now. So I'm very sympathetic to Jamie's perspective that there is a lot of uncertainty about whether the United States is going to be there consistently and strongly for allies going forward. And the last 3 weeks in that regard have been a horrible 3 weeks for U.S. allies all over the world, and frankly been a very good 3 weeks for Iran, for Russia, for the rogues, even for North Korea. And nobody really wants that. Not me, not Jamie.
In this interim period of time where we've seen so much of the disarray play out in Washington, D.C., and that has even led to just not even being able to get funds through perhaps quickly enough in some cases with regard to some of the geopolitical tensions that we're talking about. We've often seen businesses in some instances stand in the gap on other issues, whether that be social issues or whether that be innovation and Washington catch up. Where do you imagine that business executives are perhaps doing their own either side deal making or even trying to quell fears of some of their allies, their partnerships that they have internationally, where there is perhaps some dismay on the government side in having clear talks, relations that play out calmly there?
When it comes to geopolitical conflict, companies are trying to keep their heads down. You do not want to be the CEO who is known for making the loudest, most impactful statements on Israel-Palestine. You will have your head chopped off by half of your constituents, whether they are shareholders or customers or your workers. And we've seen that happen to a few CEOs, but most of them are holding fire. The same thing, it's a lot easier on Russia-Ukraine because the entire world was on the Ukrainian side. But that's becoming more challenging, of course, because the U.S. is increasingly making Russia-Ukraine into a partisan issue, whether or not there should be further support for it, and that is undermining, the perspective of those around the world that are saying, wait a second, like we're not sure if we're going to be able to continue to lead this fight. So on both of these, I mean, unlike, we can talk about climate change, we can talk about new technologies and the rest, but on geopolitics, the role for the CEO in the public debate is de minimis.
Ian, so one of the things that stood out to me that Dimon said about what's going on, like when you think about the war between Israel and Hamas and the ongoing war between Russia and Ukraine, the challenges of safety, the impact to democracy long term. What is the role of the U.S., especially when you think about the war between Israel and Hamas? What does the U.S. need to be doing to shore up the global economic stability?
Global economic stability, the United States has to not just display power, but has to display credibility. And that is the challenge. I mean, reading between the lines, Jamie didn't say it directly, but he was nudging you there. He's like, the United States lacks credibility. He said, we can be the ugly American. We sometimes get in our own way. I mean, you boil that all down. It's something I've been talking about for a few years now, which is that when the wall came down, countries around the world actually really respected American values. They believed the United States stood for something that they wanted to stand for. They wanted their political system to run more like the American political system. Now, fast forward 30 years, and you see all of this conflict and confrontation around the world. Why isn't the United States seen as that kind of a leader? And a big part of that reason, I would say a fundamental part, is that Americans increasingly don't know what their country stands for. Americans increasingly don't believe in their own political leaders and their media leaders and their corporate leaders and their finance leaders. There's the divisions inside the United States. Democracy globally is not broken. There are plenty of democracies around the world that are showing that they can work extremely well. I'd point to Japan. I'd point to Germany, the Nordics, plenty of countries. But the United States happens to be the world's largest democracy. It's the world's most powerful. I mean, largest in terms of GDP, right? Not in terms of number of people. And it's also the one that is the most uncertain, the most dysfunctional, and the one that is most divided. And that doesn't. Yeah. The funny thing is that doesn't have much impact on the United States economically, but it has huge impact on the rest of the world.
Right. Ian, just lastly, while we have you here, what comes to light with regard to so much of the conflict as it plays out is where there are entanglements economically and what countries are specifically in partnership with other countries for some economic reason or another. And on the other side of that, too, you have an era of deglobalization that we've been in for the past few years here. And so with that in mind, on the other side of the conflict that has played out, whether that be Russia, Ukraine, whether that now be Israel, Hamas, how do we get back towards a pathway of reglobalization?
Well, we've talked about de-risking now with the United States and China for a couple of years. That's the term of art. Like if you have all this confrontation and uncertainty, then you want less exposure globally to the Chinese market and to the volatility and uncertainty that comes from that country and that relationship. Well, de-risking is not just about U.S.-China. De-risking is about the Middle East. De-risking is about Russia, Ukraine. De-risking is about all of this geopolitics. So as the geopolitical conflicts become greater, as we're in a G0 world, as I call it, not a G7, not a G20, but an absence of global leadership, you're going to see more de-risking. You're going to see people much less comfortable about just-in-time global supply chains because that only works when the geopolitics don't matter. Final point, we had the pandemic for 2-3 years, and a lot of people thought, okay, well, we have to move away from global supply chains because literally you can't move goods and people from place to place. Fundamentally, this is much more about the geopolitical recession we're in than about a 2 or 3 year pandemic that we're largely out of.
All right. Thank you so much, Ian Bremmer. Always great insight from you on the global landscape. Eurasia Group founder and president, Ian Bremmer.